right, guys, let's get started. My name's Ryan. This is Amanda, and we're going to do the midterm review for you. So hopefully you guys all got the practice questions already. All right, so you got them without the solutions. I'm going to take the first 13 problems. I'm not sure if we'll get to all of them. I'll do as many as I can in my hour. Then Amanda will take over. She'll do the second half. Just so you know, this is being videotaped, so you can come back and watch it later. It'll be posted in a few days. And in addition to that, you'll also get the answers to these in a PDF. So follow along, focus on how we do it, but if you need to, you're going to get a copy that has the detailed solutions. So if I don't get to some of them, just know you will get the answers. All right? So we can get started with question 1 here. Hopefully you guys all gave it a shot or have it with you, but let's see what we're talking about. All right, so a little difficult to see, but if you have your own copy, you can follow along with that. So we have this toy company, and we get some estimates of what their manufacturing overhead is for 2013. It says $2.5 million, variable overhead of $1.6 million, fixed overhead of $900,000. LTC applies manufacturing overhead to inventory using direct labor hours as its base. All right, so direct labor hours is going to be the important thing here. That's going to be our basis for how we apply the overhead. And they estimate that there's going to be 10,000 hours of direct labor. So we then see the year plays out and have actual manufacturing overhead costs of $2.9 million. And 1.9 of that is variable and $1 million of that is fixed. All right, so a lot of numbers here, but what we actually need is at the end, it says the actual direct labor hours were 12,000. Okay, so that's going to be the important number we need. Now the question is, about the overhead, we have to basically figure out what did we estimate, and thus what did we apply, and then we have to see what actually happened. All right, so a few steps to this problem, but it's something we're going to do quite a lot. The first thing we need to do is get our overhead rate. So for our estimate for the overhead rate, we want to apply it to direct labor hours. So we're going to see that the estimated 2.5 million is what we estimated the overhead was going to be. So right, it's this at the beginning of the year before it happened. We're then going to apply that to our base of direct labor hours, and our estimate for that was 10,000. There we go. So this is how we're going to come up with our rate, and we're going to get our predetermined overhead rate is going to be $250 per direct labor hour. Okay, so just so we're all following along, this was the beginning of the year. This is what we estimated. We estimated our costs, and we estimated the direct labor hours. So this is what we're going to use to apply our overhead. Now, the end of the year comes, and we need to apply this overhead. We're going to apply that overhead to the actual amount of direct labor hours. So what does that look like? We have our $250 per direct labor hour. We need to multiply that times the actual number of hours. So if we look at the question, it tells us the actual number of hours were 12,000. Okay? So here we go, times 12,000. We're going to end up with 3 million. Okay? So we're going to apply 3 million in overhead. However, what's the question asking us? Whether we're over or under applied. Did we apply too much or apply too little? Because remember, this was an estimate. We then used the actual hours. However, that 2.5 million was our estimate at the beginning of the year. We have to see what actually happened. And we see actual overhead costs were 2.9 million. All right, so that tells us what the actual overhead is. So if we applied 3 million and 2.9 was the actual, that means we over-applied by 100,000. Okay? So hopefully that's a choice here, and if we look, we see choice E. We had over-applied overhead of 100,000. All right, so you might get a different variation of questions like this. What you need to do is figure out what you applied, what actually happened, and then you will know if you over or under-applied your overhead. All right? Yes?
Can you split that calculation by dividing
The last thing?
2.9 and the 3 million is over 5?
Right, so, all right, so we got our overhead rate, 250, right, based on estimates. We then apply it based on the actual direct labor hours, 12,000. So we apply 3 million. Then in the question, it tells us at the end of the year, the actual overhead cost was 2.9 million. So we applied 3 million, but the actual was 2.9, so we over applied by 100,000.
Thank you.
All right. Go to our next one. All right. All right, so for question 2, we have the following information was taken from the books of GMS Corporation for June. A lot of numbers here. We have our raw materials beginning and ending. We have our purchases. We have our direct labor, manufacturing overhead, work in progress, and finished goods. All right. So we're going to need to use most of this information because ultimately what we're looking for is what was cost of goods sold for June. So I tell everyone in the textbook, there's an example that is almost exactly like this. Practice with it. Make sure you can get from beginning raw materials to ending cost of goods sold. If you can do that, that means you can get through any section of it. So maybe if you have a question on test just about work in progress or raw materials, as long as you can do a whole problem like this, you'll be able to pick that part out. So we'll go through this here. It's really just a step by step. So we're going to have to do 3 different steps here. But if we want to get the cost of goods sold, let's start at the beginning. We'll start with raw materials. That's what's going to go into our work in progress. That's what's going to turn into finished goods. So we have to start there. So starting with our raw materials, you have all these equations in the slides or your textbook. Make sure you have them memorized. And really, it's just going to be a puzzle using the different equations. But I'll show you how to do it here. So our raw materials, what was our beginning balance? It says 200. So equation 1, raw materials beginning was 200. What did we do? We purchased some more. So if we purchase more materials, how much should we purchase? 1,500. Okay. So we purchased 1,500. However, at the end of the year, there's still some in there at the end. So if there's 300 left at the end, that means we didn't use those 300. So if we're trying to figure out how much raw materials got moved into work in progress, then we want to take out our ending of 300. Okay? So if we just do that math, we end up with 1,400 of raw materials went over to work in progress. All right, so that's step 1, starting at the beginning with the raw materials. Then let's go over to our work in progress. Similar approach as the raw materials. What do? We start with the beginning, which they give us is 800. We then need to figure out what went into work in progress. So the little of this is memorization. Now we have to know this stuff goes in. We need to look at the raw materials that went in. We need to look at direct labor. We need to look at our overhead that we applied. So we'll do that step by step. The direct materials, just hold on one sec. What was that?
Because you put the beginning 800, so is that supposed to be 1,800?
Okay, so 2 different things here, right? This is raw materials. Okay, so that's one account. Work in progress is another account. So we start with the 800. They tell us the beginning work in progress was 800. Okay, so 2 separate accounts. Now what we do is we take this 1,400 of raw materials and we put it into work in progress, and we say that was the direct materials that went in to work in progress. So the other things we need here, we have direct materials. 1,800 is the direct labor. Where's that? So we just take that right from there. All right. So we need to include that in our work in progress. And then finally, where do we have it here? Our manufacturing overhead. All right, so remember the cost of a product, direct labor, direct materials, manufacturing overhead. So we put all of that into work in progress. All right, and just like we did with raw materials, we want to subtract out the ending balance. because we're trying to figure out what went through raw materials to become finished goods. We have the beginning, everything we put into it, and then we want to subtract out what's left because we know that's not finished goods. Is there a question? Yeah.
Yeah, can you just like say the abbreviation rather DM?
So this is direct materials. We calculated it using the raw materials equation. It goes into work in progress. This is direct labor, which they just told us, and this is manufacturing overhead, which we're also given. All right. So we add all that up. So we say $6,000 worth of product moved through work in progress to become finished goods. All right, so this is going to be going to finished goods. Now remember, what are we ultimately looking for? Cost of goods sold. So we're not there yet. But now that we know how many new finished goods got created, we can use our finished goods equation. All right, so here we are in finished goods. Same process, right? This is the third time we're doing it. We're beginning inventory, finished goods, 1,200. Okay, so finished goods, 1,200 is what we started with for finished goods. We then want to add how many we made. So what came out of work in progress, where does it go? It goes to finished goods. All right, so that number is what we calculated here, 6,000. So that 6,000 came from work in progress. So hopefully you can see we had to start here to get to there. Ultimately, to get to our finished goods account, we add the 6,000 that came out of work in progress, and then we also want to subtract, just like the other two times, our ending balance. Because what are we looking for? Cost of goods sold. If it's still in finished goods inventory, it wasn't sold. So we want to take that out. So this is everything they could have sold. 1,200 is the beginning, plus everything they made. And then we just want to subtract out what they didn't sell. And what we're left with should tell us how many they sold. So 1,000. All right, so that's our ending balance. We did all of that to get to 6,200. And that is going to be their cost of goods sold. Remember, just definitionally, cost of goods sold is everything they could have sold, subtract what they didn't sell. This must have been what they sold. And that's choice C. All right, so a little bit of a long one, but this, make sure you practice this a bunch of times. All right, and you'll get into a rhythm. You're kind of doing the same thing over and over again, but you're going to need to know how these different accounts flow into each other. Is everyone good with that? All right, go next one. So another company, Complex company, has the following estimated cost for next year. Complex estimates that 15,000 direct labor hours and 20,000 machine hours will be worked during the year. If overhead is applied on the basis of machine hours, the predetermined overhead rate will be. Okay. So they flat out tell us they apply overhead basis of machine hours. So we care about that number, right? So what we need to do here is we need to figure out what is estimated overhead, divide it by estimated machine hours, and that gives us our predetermined overhead rate. The real trick is, the question is, what of this stuff is overhead? All right, so this is a little bit of math, but mainly it's kind of knowing what each account is. So direct materials is not overhead. Direct labor is not overhead. Sales commission, that's a selling cost, not overhead. Now the salary of the production supervisor, that is going to be overhead. So that's going to be something we're going to have to apply. So we're going to include that one, yes. Indirect materials is also overhead. All right, we can't trace it to a specific product, so we include it in overhead. Advertising expense is a selling cost, not going to be in there. Rent on factory equipment, yes, is going to be in there. All right. So this is kind of memorization, knowing what goes in and what doesn't go into your overhead. So if we take those numbers, we end up with 35,000 plus 5,000 plus 16,000. Is that right? So we just took those three numbers out. This is what our estimated overhead is. You got 56,000 beginning of the year. That's what they estimated for overhead. What are we looking for, though? We're looking for the predetermined overhead rate based on machine hours. So total estimated overhead, divide it by the estimated machine hours, and $2.80 is our predetermined overhead rate. And luckily, right there, choice D. Yes?
I'm sorry, so I understood 35,000, that's the total overhead, but what is the 5,000?
So 35,000 is the salary of the production supervisor.
Oh, okay, you added, okay.
Yeah. Indirect materials is 5,000 and rent is 16. So this is just 56 is the total estimated overhead, and then the 20,000 is the estimated machine hours. So this is our predetermined overhead rate, $2.80 per machine hour. All right. So question 4. We have, yeah. Yes. All right. So question 4, we have Debbie's Bakery here, and they have a 2012 income statement. You determine cost of goods sold, selling, administrative, variable, fixed. It's as follows. All right, so we have a lot of numbers here, but what is the question asking? 2012 contribution margin for DBC. So this is really more of a definitional question. What is the contribution margin? It's going to be the sales revenue minus all the variable costs, right? We're going to use that. We have our contribution margin. We're going to not include the fixed costs here. Those are included in profit, but all we're looking for is the contribution margin. So if we have $1 million in revenue, we just need to take out the variable costs. Unfortunately for us, give us a lot of information here. All we care about is the variable portion, 525. So simple enough. What do we end up with? 475. All right, so that's a nice, quick, easy one. Just remember, what is the definition of contribution margin? And you basically have your answer with those two numbers. So answer is C, 475,000. All right. Oh boy. Okay. All right. So, man, I'm just gonna need your help a little bit with the slides here because this is a multi. All right. So this question, we're going to have questions 5 and 6 are both going to be based off this example, this company. And the question is about dollhouse manufacturers. And they give us some information here, and then we'll go on and we'll solve it for number 5 and number 6. Might have to flip back here. What we're trying to do is we're trying to figure out what is the cost for one of these dollhouses. They make large dollhouses and they make small dollhouses. So we're given direct materials and we're given direct labor, right? So this is per dollhouse. So we're going to need to use these numbers at some point. But then for the total cost, we have to basically know how much overhead do we apply to each one. So any other numbers here that we need? Not particularly. All right, so these are going to be the numbers that we need to take care of. So can we go to the next one? Okay. So for number 5, let's say overhead is applied on the basis of machine hours. It takes 3 machine hours to produce a large dollhouse and 2 machine hours to produce a small dollhouse. This company produces 2,000 large dollhouses and 10,000 small dollhouses per year. Total manufacturing overhead is $780,000. Under the traditional job order costing system, what is the cost of one small dollhouse? Round to the nearest dollar. All right. So basically what this is going to turn into is we're going to compare the costs doing it the traditional way with our predetermined overhead rate versus doing it based on activity costing. So question 5, we do it the normal way, and then question 6, we'll do it activity based. So let's start with the simple one. Question 5, the question is, how are we going to apply the overhead? And they're asking about small dollhouses. But first we need to figure out total overhead that's going to be applied to all of this. They tell us $780,000. All right. So if that's our total estimated overhead at the beginning of the year, we then need to divide that on the basis of machine hours. So the trick here is figuring out how many machine hours we expect for the year. And what that's going to be is just figure out that they make 2,000 large dollhouses and 10,000 small dollhouses. We need to know how many machine hours it takes to make each one of those. And fortunately, they tell us 3 machine hours for a large, 2 for a small. So if we're trying to figure out what the total machine hours will be, we got 3 machine hours for the large dollhouse times the 2,000 that they're going to make, plus 2 hours per small dollhouse times the 10,000 they're going to make. All right, so this is a little trickier than some of the others we've done where they just flat out tell us this is how many machine hours. You just have to do a little work. But once we calculate that, we end up 780,000 over 26,000, which means our pour is going to be $30 per machine hour. Okay, so that's going to be our predetermined overhead rate. We're going to apply it based on the machine hours, $30 per machine hour in overhead. Now, the question's asking us, what is the cost of one small dollhouse? So, man, if you just pop back one slide, they tell us for the small dollhouse, $30 in direct material and $15 in direct labor. We can go back now. Thank you. So for a small dollhouse, direct materials is $30. Direct labor is $15. Now we have to do the overhead. And the overhead is $30 per machine hour. And it tells us it takes 2 machine hours to produce one dollhouse. So what's that going to be? $60 in applied overhead. All right, so make sure everyone's good with that. I'm doubling it because it takes 2 machine hours to make one small dollhouse. And what do we end up with? $105 per small dollhouse. And that's a choice, right? All right, so that's B. That's the traditional job costing method. All we did is take total overhead by total machine hours, and we just applied it. Manufacturing overhead. Okay. All right, just make sure everyone's good with that 60. And now, if we go to question 6, what's really happening here is we're going to use a different method to apply the overhead. And it's still going to be the same question, but we're going to use activity-based costing. All right. So for question 6, EDC does an activity-based costing analysis and identifies 3 major activities. So of this 780,000 they told us total overhead was, they can break it down and see where it's coming from with these 3 different activities. So if we're trying to use the activity-based costing method, what we're going to do is calculate the applied overhead using activity-based. So what do we have to do? Normally we would take each of these overhead buckets, and divide it by total direct labor hours, machine hours, and orders. Fortunately, they already do that for us, right? Everyone see? They give us per unit overhead charges for that. So if what we want to do is find out what overhead we're going to apply to the small dollhouse, and these are our rates, 58, 4, and 320, we're going to multiply them by the activity associated with the making of the small dollhouse. All right, so step 1, take that 58 times the 6,000 of activity. We then take the $4, multiply that by the 20,000 in activity, and then take the 320 and multiply that by the 200. All right. So we're just going across this little chart they give us here. Get 300, 48,000, 80,000, and 64,000. All right. If we add all those up, you get 492,000 in overhead associated with the activity for the small dollhouse. Okay. However, this number is for all the dollhouses. The question is about the per unit cost. So to get that, we want to divide by the number of dollhouses that they make, which, back a slide, if you don't mind, they tell us that they produce 10,000 small dollhouses a year. So if we want to get per unit, we divide this total cost by 10,000, and what do we get? 49.2 in overhead. So 49.2 is the overhead that's going to be applied to one single small dollhouse. We're asking what the total cost is, though. Remember, these different methods for applying overhead is exactly that. It's applying overhead. It's not direct materials or direct labor. Those stay the same, even though we're using different methods for the overhead. All we're changing is overhead. So it stays the same. That means it's still $30 in direct materials and $15 in direct labor. So that means the cost for the dollhouse is 94.2. So, I'm sorry?
For one.
Right, so yeah, so what is the cost of one small dollhouse? We took the total overhead for all the small dollhouses and divided by 10,000. So then we end up with the per unit. All right, so 94.2, it'll be choice B, $94. All right. I'm not sure if I have another activity-based one, but make sure you're comfortable with the difference between the traditional overhead application and activity-based, because you want to be able to calculate it both ways. All right. Question 7. All right, so now we're going to move in a little bit to Chapter 6 stuff, which is mainly focused on our contribution margin, profitability, and break-even, things like that. So this is our first one that we're going to look at here. Question 7, we had a company that has a break-even point of 400 units sold. Variable expenses were 4,000. Fixed expenses were 2,000. What will be the 401st unit sold, or what will the 401st unit sold contribute to profit? All right. So they give us a bunch of numbers here, but they're essentially saying what is going to be the contribution margin for one more unit being sold. So how much are we going to make off that one unit? So just some equations we always want to keep in mind. All right, profit quantity. All right, so This is kind of basic, but you're going to end up, this is going to be the basis for how you solve most of these. Just remember our profit is going to be our contribution margin, which is the difference between the price and the variable cost, times how many units we sold, and then subtract out the fixed costs at the end. All right, so we want this little portion here to be big enough to cover our fixed costs, and that's how we make money. So when we rearrange this equation, they tell us the break-even point. So what does break-even point mean? That's when we make $0 in profit. So if we restate that, 0 in profit is equal to the contribution margin minus the $2,000 in fixed costs, right? So this should equal 0 at our break-even point. So what that tells us is that our break-even point, our total contribution margin is 2,000, because that means we just cover our fixed costs and we end up with 0 profit. All right, so just an important thing to know there. So if our contribution margin is 2,000, let's remember variable costs is equal to 4,000, right? So what that's telling us is when we take our revenue and minus our variable costs, we end up with a contribution margin of 2,000. So what does that say? That means revenue is equal to 6,000. Okay? So once we know this, we can then go to find out what we're actually trying to solve here. If revenue is 6,000, we can figure out what the sales price is, because we know with 6,000 in revenue, we get 0 profit, and we sold 400 items. That's our break even in units. So if we take that 6,000 in revenue, divide it by the 400 units we sold, right? They told us at this stage we would have sold 400 units. So $15 sale price. At this point, this must be what we're selling these for. We then have our variable costs, which we know are 4,000. And we just divide that again by the 400 units. All right. So if we do that, we get $10 in unit variable costs. And by definition, if we go back up here, this is what we're looking for, what one unit contributes, right? So, and that's simply sale price minus the per unit variable costs, $5. Okay, I'll tell you there are a number of ways with these problems. You can solve it many different ways. I wanted to spell it out, everything here. If you want to work a little faster, there's another way to get there. But when you're asking for the 1 unit contribution, you know the difference between the sale price and the per unit variable costs, and it's going to be $5. You can, these types of problems you can solve many different ways. So I think Professor sent out a Blackboard message to you guys about trying problems, trying to solve them different ways. That's some good advice. With these types of problems, see if you can solve them multiple ways, so that depending on how it's asked, you might be able to solve it quicker on the test. All right? Yes?
Is this the easiest way, or do you have something that we can use that might be shorter?
I mean, the main thing, the whole point, I mean, I'm spelling this out, is you know fixed costs are 2,000. You can pretty quickly know that means the contribution margin has to be 2,000. So if you know that and you know variable costs, I mean, this is probably the easiest way to do it. We're going to do a few more. I have a bunch of these, so you'll get some different looks at different ways to do it. This is just how I had it prepared. Yeah.
What's the logic behind finding 6,000 for the revenue?
So the revenue of 6,000, we know that figure out what the sale price of the actual item is, because they don't tell us what that is, right? So if we know contributions 2,000, variable costs are 4,000, revenue has to be 6, and then I use that to get the $15 sale price. All right. Question 8. How are we doing on time here? 11:04. All right. So question 8, Danny's Consulting Company, DCC bills clients by the hour. DCC bills clients $250 per hour for the consulting provided. They have a variable cost of $100 per hour. They have fixed costs of $300,000. How many hours must DCC bill to clients to break even? So remember our equation. We're going to be using this again. At our break-even point, our profit is 0. So 0 is equal to 250 is how much they charge, so we can think of that like the sale price, minus the variable cost per hour, which they tell us is 100, times our quantity minus 300,000. All right. So the question, what we're looking for is the quantity, how many hours we have to do, right? Or how many units you would sell. So we could say this difference here, they make 150 in contribution per hour. So 150 times the quantity minus 300,000, right? So solving for Q there, 300,000, go to 150Q. Q is equal to 2,000. Okay? So with this break-even stuff, you just have to know profit 0. And then depending on what they give you, sometimes you have sale price, sometimes you have quantity. But knowing the identity of that equation is going to be the start for all of this. So what was that? 2,000. That's choice E. Okay. All right. So we got a few more of these. All right. So Juliet's Children's Clothes Company has a target profit of 100,000. That profit requires unit sales to be 2,000. Their variable cost per unit is 100, and fixed expenses are 50,000. If JCC achieves that target profit, what is the margin of safety in units sold round to the nearest unit? All right. Try to do this here. All right. So we're talking about a target profit of 100,000. Per unit, we don't know what the sale price is right now. All right, so we don't know that. We do know that the variable costs per unit are 100. They also tell us the profit requires unit sales to be 2,000. All right, so they give us Q in this case. 2,000. And then finally, we need to take out our 50,000 in fixed costs. All right, so if we rework that, we got 150,000 x minus 100 times 2,000, 75 x minus 100 x. All right. So 175 has to be the price at this target profit. Okay? So all we did here is we put the numbers in and we solved for what the unit price has to be. So once we know 175 is the unit price, we need to figure out, we're looking at the margin of safety. So the margin of safety is what percentage over your break-even sales are you achieving. So what do we need the break-even sales to even get there. Yeah?
20,000 to the right side, right? And then it's supposed to be 50,000.
I divided the 2,000 into the 150,000. That's right, right? Yeah. Okay. All right. So margin of safety, the key thing we have to know is we have to figure out what our break even is. So, all right. So at a break even, that means our profit's 0. So break even, we know our sale price is $175. We have $100 in variable costs. We don't know how many we have to sell to break even. That's what we're going to solve for. And we have 50,000 in fixed costs. Right? So this is break even, profit is 0. Move that around here, you get 50,000. 50,000 is equal 75 times Q. All right, so when our contribution margin equals our fixed costs, we just want to figure out how many units that is. And units is 667 units. That's how many we have to sell for break even. Yeah.
In the narrative matrix, in most of the examples, I always round down to break even. Let's say 402 units.
Yeah. And that's not an issue with any of the ones I'm doing here, but yeah, you have to get over break even, yeah. So 667 units sold. So if we sell 667 to break even, how many did we sell for our target profit? 2,000, right? So we just take the 2,000 minus 667 is 1,300. Okay? So this margin of safety in units sold. This is how many units we sold. This is how many units we would have had to sell to break even. So the margin of safety is 1,333. Okay. How are we doing time-wise? All right. All right, so we got some more of these. Well, let's look at question 10. All right. So we have Rory's Bridal Shoe Company. We got the following data. Sales of 3,000 shoes, sale price 70 per shoe, variable cost 50, fixed cost 25,000. And question, what is Rory's net operating profit for the year? All right. So real quickly, we can come here and we can say they're selling them for 70, their variable costs are 50, contribution margin is $20 per unit. So if we're trying to solve for our NOI, we got a contribution margin of $20 per unit times how many units they sold, which is 3,000 shoes. However, what do we always have to do? We got to remember to take out our fixed costs when we're talking about profit. And fixed costs are 25,000. All right. So solving for NOI, we get 60,000 minus 25,000. All right. And that gets us 35,000 in profit, which is choice A. Right. So that's a relatively easy one, but just make sure you can do it, and the key is just figuring out this $20 in contribution per unit. All right. All right. So let's go to question 11. So same company, but we're just going to make it a little trick here. It says if the dollar contribution margin per unit is increased by 10%, total fixed cost is decreased by 20%, and all other factors remain the same, what will net operating income be? All right, so before, remember we solved $20 per unit, and they sold 3,000 units, so our contribution margin was 60,000. All right, so this is the old situation, and the fixed costs were 25,000. Okay, so this is from last time. Now they're saying the contribution margin per unit goes up by 10%. So that means our total contribution margin is going to go up by 10% because they sold the same number of units. So we're just going to multiply this by 1.1 to get a new contribution margin of 66,000. Okay. Fixed costs, they decrease by 20%. So I'll multiply that by 0.8. And our new fixed costs are 20,000. So in this new situation, we're going to make 66,000. We're going to pull out fixed costs of 20,000. So our new profit is going to be 46,000. Now, the old profit from the question before, we hopefully remember, we solved, it was 35,000. That was just what question 10 was asking us. And the difference here, plus 11,000. So from the options here, you find it, choice D, this is going to increase NOI by 11,000. So increased contribution, decreased fixed costs, obviously profit is going to go up in that scenario. So for choice D, increase by 11,000. Yeah. Say it a little louder. Speak up a little bit. All right, so 60,000 from the last question was our contribution margin. We make $20 per shoe. We sold 3,000 shoes. They say if it goes up by 10%, so if the per unit goes up by 10%, but you sell the same amount of units, the whole thing goes up by 10%. So this is just increasing it by 10%, multiplied by 1.1. And that's what the new contribution margin is going to be. Okay. How am I doing? All right. All right, this is my last one. It's a little long, but then I'll pass it off to Amanda. It's a good question, though, so hopefully we'll get it done in the next 10 minutes. All right. So Jonathan's Golf Company, it's analyzing its selling costs for the prior 4 quarters, had the following selling costs and golf clubs sold. JCC uses the high-low method to determine what its selling costs will be in the next quarter when it anticipates to sell 100,000 units. So you just have to understand the high-low method, and we're just going to do a pretty straightforward example here. The issue is we're talking about something called mixed costs. So these selling costs, some portion of them are fixed costs, and some of them are variable. High-low method is the method you use to try to determine how much the variable cost is compared to the fixed. So with the high-low method, you look and you find this is the highest activity of 120,000 golf clubs sold. You then want to find your low scenario of 50,000. So basically you're kind of calculating a slope here because you're going to want to see what the change in selling costs are divided by the change in units that created that change in selling costs. And by doing that, we're going to be able to break down which portion of this is fixed. So you just do high minus low. The numerator, we'll do selling costs, 1.7 million in the high activity, minus $1 million in the low activity. So the numerator is going to be dollars divided by your change in quantity, which we have 120,000 in the high activity and 50,000 in the low activity. Okay, so that's the setup for the high-low method. Once you do that, what you're going to end up with is you're going to get a change 700,000, 70,000. So the difference in how many they sold is 70,000 units between a high and a low, and the change in their expenses is 700,000. So what that's telling you is that by increasing sales, that there's a variable cost of $10 per golf club. Right? So when they sold 70,000 more golf clubs, their cost went up by 700,000. So that means each golf club they sell, that there's a $10 variable cost per unit. Okay? So you're just comparing two scenarios, and you're standardizing and showing that increase in units, increase in costs, the variable cost is going to be $10 per unit. All right, so that's step one. Ultimately, we're going to have to project forward, but once we have $10 variable cost per unit, we can go to either the high scenario or the low scenario. It doesn't matter which one you use. I'm just going to use the high here. So we say in the high scenario, we have total cost 1.7 million, right? Just take that right from there. And what is total cost? It's variable costs times the number of units plus fixed costs, right? So fixed costs is some number we don't know. So we're going to have to solve for that. Plus our variable costs, we just solved before, $10 per unit times how many units did they sell? 120,000. Okay? So this is what total cost equation looks like. We want to solve for the fixed cost. So if we do that, 0.7 million, fixed costs plus 1.2 million, and we get over here, fixed costs 500,000. Okay, so just do a little algebra and solve for your 500,000 in fixed costs. Why do we need all that? It's because we're trying to anticipate what's going to happen next quarter when we sell 100,000 units. But now that we've done all this, we have the pieces that we need. So we'll come over here. So we're going to be projecting for the quarter when we sell 100,000. What is the total cost going to be? Well, it'll be 500,000, which is the fixed cost we just solved for. That's going to be there no matter how many we sell, plus our $10 in variable cost per unit times the 100,000 units that we plan on selling. So when we simplify that, we got 500,000 plus $1 million. That means total costs is going to be 1.5 million. All right, so does anyone have any questions with that? Yeah.
When finding the fixed cost,
Yes.
we should definitely use only high or low scenario, or
Yes.
we can use anything.
No, use either the high or the low, but it doesn't matter which one you use. Yeah, so hopefully everyone's understanding. The reason we're doing this is because with just these numbers, we don't know what portion is fixed or variable. And by taking these high and low scenarios, you kind of think of it like a graph like this. And that's going to be your cost. That's going to be your quantity. And you basically have 2 points like that. Your low scenario and your high scenario. And now you want to project how much it's going to cost to be maybe somewhere in here or somewhere out there. And by doing this, when we solve for this $10 variable cost, this is just like doing a slope, like in math class, right? So just, we solve for the slope, and we get $10 in variable cost per unit. That was step one. Step two, when we're trying to find this fixed cost number, what we're really doing is we're projecting to what that is down there, right? So we know with this slope, it will arrive to a fixed cost somewhere there. And then with step three, all you're doing is you now have the line and you have the fixed cost, which is the starting point. So you're picking a time in the future, just 100,000, somewhere right in the middle. So next quarter, you're basically solving for that, and you're just using your equation. And now you know the fixed cost and the slope. Yeah. So the 100,000, they tell us next quarter they anticipate to sell 100,000 units. All right, so other thing hopefully you can see, this is the last thing to point out here, this is with 100,000 units, the cost is 1.5 million. That puts us right in between our low and our high scenario, right? The 100,000 is somewhere between this 50 and 120. So that would imply that the total cost is going to be somewhere between the 1 and the 1.7. So that's why the 100,000. And you know you did it right if you have something in the middle and the price comes out to the middle. Yeah.
Is it a coincidence that if you're trying to use others, other than low or high numbers, you get the situation?
You probably would, but you just use the high or the low one. All right. Mandy, you want to take your side? All right. You want this marker? Or?
Yeah, sure, if it works well. Okay, so we're going to start on the second half. I'm going to skip a couple of the questions, and then if we have time, I'll get back to them. That's intentional because just in case we don't have time for all of them, I want to definitely go over certain questions. So I'll definitely tell you guys which question I'm going over, and you'll see, so there's no confusion. All right, so the first one is question 13. And just like the last question, we're going to use the high-low method here. So this question provides number of x-rays taken and the x-ray cost over the last 9 months in a hospital. So we're going to want to highlight the high month activity and the low month activity in order to use the high-low method. So we can see the high month activity is in February with 7,000 x-rays, and the low is in June with 3,000 x-rays. So the question asks, what's the hospital's estimated monthly fixed x-ray cost? So the first thing we're going to do here is we're going to just write down the high activity and the low activity. and the high cost and the low cost. And then we'll take the difference. For the activity, it's going to be 4,000. And for the cost, we're going to get 12,000. Now we use these numbers to first estimate the variable cost per unit. So the way that we do that is just by simply taking the difference in the cost, so 12,000, over the difference in the activity. So the estimated variable cost per X-ray is going to be $3. Now, because we're given the total cost information and we now have this variable cost, we can then find the fixed cost. Using this, if you're reading the textbook, you're familiar with this formula here. So A represents the fixed cost, B represents the variable cost per unit, and X represents the number of units. So I'm going to use the low activity here. Again, you can use either the high or the low activity, whichever one, you'll get the same fixed cost. But we have the total cost is 17,000. That's just given information. We don't know the fixed costs yet. And then we already calculated our variable cost of $3, and we know the number of units. So if we solve for this equation, then we'll get FC, I'm abbreviating, it's fixed cost, right? So we'll get the fixed costs of $8,000. So this one's a pretty nice question, because if you know the high-low method, it's a very simple solution. Yes?
Associate with the high.
So you're going to go by the activity level always. So you're always going to look at the activity, so the first column in this case, to decide the high and the low months or quarters, whatever the case. Okay, so choice A. Okay, so now we're going to do question 15. So I'm skipping question 14 for now. And the logic is basically if I think that Ryan covered enough questions about it, I'm just prioritizing the questions, all right? So we're going to 15 now. We're skipping 14. We may come back to it if we have time. Hopefully we have time for all of them. So this question, they provide the information that for two of their products, they have two products, product A and product B. So they provide some information, the number of units, the direct material per unit cost for each of the products, and the direct labor costs for each of the products. And the question is asking for the unit product cost of product B specifically. So we're going to be focusing on product B, and we want to find the unit product cost. So the unit product cost is going to be what? It's going to consist of all of the costs that go into manufacturing a product. And everyone, I'm sure, knows that these are the three costs: direct materials, direct labor, and manufacturing overhead. And specifically, because the question asks for unit product cost, we want the cost per unit on a per unit basis. Okay, so for direct materials and direct labor, we already have that information given. So we're only going to focus on trying to find the overhead cost. So the question specifies that they're using activity-based costing. So we know that this is the method that we're going to use to apply our overhead. So in activity-based costing, what we have to do for each of these activity cost pools that are provided is calculate a rate that we're going to use to apply overhead. So we start with the first one, setups. In order to calculate the rate, we're going to take the estimated cost of $240,000 and divide it by 120, the total activity across both of the products. So this is a common mistake. Just because you're looking for product B here, don't divide by product B. In this scenario, we're looking to just estimate a rate that's going to apply to both products. We're going to bring in product B later when we're actually calculating the amount for product B, and you'll see how that works. So we're going to take the 240,000 divided by the 120, and we'll get for our rate 2,000, and that's per setup. So this column indicates the driver here, so we know it's going to be per setup.
How did you get the 2,000? You divided what by what?
I divided the estimated cost divided by the estimated total activity. So that's 240,000 divided by 120. So now we're going to do that for the other two activity cost pools. So what do we do for general factory? We're going to have 600,000 divided by 20,000. So when you're calculating this rate, you can pretend that these two columns don't exist for now, as long as you have the total. However, there might be a case, let's say on an exam, where you're not given this. All you have to do is simply add up the two, right? Because those are the only two products of the company, and you'll get the total. Yes?
On the printout, it says that the total was 12.
That's
not
a typo.
120.
Yeah, that's a typo. Yeah, it should be 120. Because 80 plus 40, we know it has to be a typo, because that'll add up to 120. Okay. So now we calculate for general factory. 600,000 divided by 20,000. That's going to be $30 per direct labor hour. And now we're going to go to machine processing. We're going to do 120,000 divided by 3,000, and that will give us $40 per machine hour. Okay, now we have our rates. And what we do, this is the same thing as what we do when we're using just one predetermined overhead rate, is to actually apply the overhead for a given product, we multiply this rate, this overall rate, times the actual activity. So here we see it's expected activity, so where's the actual? The question specifies that actual activity is the same. So we're using actual activity in this calculation that I'm about to do, but it's going to be the same as the expected activity, so that simplifies things a bit. Yes?
And the second questions will be like the actual activity always as expected activity, or we can actually have to find it out the actual activity?
No, it's not necessarily going to be the case. It would have to specify that the actual activity is the same. If not, then you're going to use always the expected activity in the first stage to calculate the rate. And in the second stage, you'll use actual activity to the extent that that's actually specified in the question. No problem. So here we're going to focus only on product B, because that's what the question is asking for. So we take each of our rates in turn. So first, setups. We know that that's 2,000 per setup. And we're going to multiply that by the actual activity, which is equal to expected, times 40. Times 2,000, times the rate. Okay, so we have a total of 80,000 just for the setups cost pool. We have to now proceed to the other two cost pools. Okay, general factory, same process, $30 that we calculated earlier, times the actual activity for product B, So here we're going to get 300,000. And then finally, machine processing, $40 times 1,000. So focusing on product B. Okay. This is the applied overhead for the setup cost pool. This is the applied overhead for the general factory cost pool. And this is the applied overhead for the machine processing cost pool. We have to add them up to get the total applied overhead. Okay, so we will get 420,000 as our total. So we want specifically a unit product cost at the end, right? So that's what we're trying to get to. So let's express this in terms of units. We know that for product B, there are 10,000 units produced. So we can just divide this 420 by 10,000, and we will get $42 of applied overhead per unit. And we're not done because we have to add in the direct materials and the direct labor in order to have the complete product cost. So this information is given already. The 84 just comes from this column here, product B. The direct labor, again, we're only looking at this column, $12. And the overhead we calculated, that's what we spent pretty much most of our time here doing. And we'll get to a total of 138 per unit. Okay, so the answer here is A. Okay. Now question 16. So we're going to jump to chapter 6. The question states, last year, a company reported sales of $640,000, a contribution margin of $160,000, and a net operating income of $40,000. Based on this information, the break-even point in sales dollars is blank, was blank. So here, similar to the questions that Ryan was going over, we want to know, we want to start with the basic equation. And then if you want to take shortcuts and use the simplified formulas, that's fine. But I think knowing the overall equation is helpful because in the case that you forget the formula, you can always go back and figure it out. So let me explain. So we know that our profit equals sales minus variable costs minus fixed costs. So this just goes without saying, that's always what profit is. It's sales minus the cost that you spend to produce those sales. So further, we can notice that this first portion of the equation is the contribution margin. Okay, so let's see what we were actually given in this equation and see what we can figure out. Okay, 640. This is given. We were also given the contribution margin. We can figure out, of course, what the variable cost is just by knowing these two pieces of information. We don't really have to do that in this question, and you'll see why. So then we have the fixed costs. We don't know this yet, but we do know what the net operating income is. Because we know the contribution margin and because we know the net operating income, we can easily get the fixed costs. That's going to be $120,000. We need to know that because in the end we're trying to plug information into this equation, because the break-even point is just this equation, but we emphasize that the profit is always going to be equal to 0 at the break-even point. Okay, so we have our profit as 0. We don't need to find anything there. We know that our fixed costs are $120,000. And here's the part that we need to do some work on. So we're not sure how to get this portion. And there is a way, the way that we do that is by noticing from the given information that because the contribution margin is 160 and the sales are 640, that the contribution margin ratio is 25% or 0.25. So what does this mean? Just as a percentage of sales, the contribution margin is always going to be 25% of sales. So then what we can do I can specify here really, these are the break-even sales. If I solve for this equation, I'm going to get the break-even sales because I know that this is always going to be 25%, the contribution margin. So if you can manipulate this portion of the equation in different ways, and if you don't remember how to, go through Chapter 6, this is going to be a huge help to you on the exam. So in this case, I'm using the contribution margin ratio.
Minus variable cost is equal to the contribution margin, right?
Yes.
But then you wrote there contribution margin equal to 160,000.
Yes.
So did you just plug it there?
No, this is the contribution margin in the given information, but that's not what we're trying to find. We're trying to find the break-even point. So we're just using this given information to come up with the ratio that helps us to calculate the break-even point. Okay, so this simplifies to 120,000 over, which is why in your book you'll see as a formula the fixed cost over the contribution margin ratio will give you the break-even sales. That's really all just coming from this. It's derived from this main formula. So then we arrive at 480,000 of the break-even point in sales, for the break-even point in sales. And that's choice B. So we're going to try to come back to 17 if we have time. Question 17 is really about understanding the flow of these inventory accounts in order to get the cost of goods sold. Ryan went over a problem like that already. It'd be good to go over another one, but we'll come back to it. Now we're going to do question 18. Okay. So the work in process inventory account of a manufacturing company shows a balance of $2,600 at the end of an accounting period. Okay? So we're going to be looking at the inventory accounts. The job cost sheets of the two uncompleted jobs show charges of $400 and $200 for direct materials, $300 and $500 for direct labor. From this information, it appears the company is using a predetermined overhead rate as a percentage of direct labor cost of blank. Okay, so this question requires knowledge of how the work in process account works. So we have 2 jobs, that's all there is in this company, and they're both uncompleted. So I'm going to choose to look at this in the T account format. If you don't like T accounts, you can just use the equation method to find what you're looking for. But we're going to have a beginning inventory of 0 because we only have these 2 jobs and we didn't have anything beforehand. So the beginning inventory is 0. Then we know that in work in process, we put in the product costs for the products that are currently being manufactured, that are currently in process. So the first product cost we have is direct materials, and we're given the information. And we see for the first job, it's 400, and for the second, it's 200. So we just need to add those together to get the total. So we're also given the second cost that we're going to consider here is direct labor, and we're also given that information. So we can just add those up. To get our direct labor cost that's going to be included in work in process. Okay, now we always know that the other component is applied overhead. We don't know this right now. We're not sure what this is. We would have the cost of goods manufactured here, normally, but in this case, the jobs are uncompleted. They're not moving to finished goods yet, so we'll have 0 there. You don't really need to include that, but just for completeness, I am. And then we'll have the ending. So here we have a balance of $2,600, and we know that because it's just provided in the question for us. So because we know all of this other information, we can easily calculate the applied overhead. So all we have to do is take our ending inventory for work in process and subtract out the direct materials and the direct labor costs, and then we're going to get what's left. And what's left is going to be the applied overhead. So if we do that, we'll get $1,200 of applied overhead. Okay, so we figured this out. But that's not what the question is asking for. The question is asking how we apply this overhead as a percentage of direct labor cost. That's the allocation base. So we know that applied overhead is always going to be equal to the predetermined overhead rate times the actual allocation base, the actual activity. In this case, it's going to be direct labor dollars because we're told that. So the applied overhead of $1,200 that we found already equals the predetermined overhead rate, which is what we're trying to find, but we don't know, times the actual direct labor dollars, which we know to be $800. So then it's simple to find the predetermined overhead rate. If we divide the $1,200 of applied overhead by the $800 of direct labor costs, then we arrive at a percentage, 150%. So now we understand how applied overhead was calculated. So we get choice D. So in this problem, it's very important to know how this work in process account works. And yeah, I would recommend just knowing like the back of your hand how raw materials work in process and finished goods work. If you know what goes into those, you can back into a lot of information. Okay. So now we're going to move to question 19. And this is a chapter 6 question. So we're looking at a company that distributes a product, and that product sells for $50 per unit. Variable expenses are $10 per unit. Fixed expenses are $15,000 annually. So in this situation, the company sold 4,000 units, and now we're going to have some changes. So the sales manager thinks that if we reduce the selling price by 10% and we increase advertising expenditures by 30,000, then we can increase unit sales by 50%. So if these changes are made, how much would our net operating income, or NOI, increase or decrease? So here we want to do a comparison between what we have now in the current situation and what we would have were we to apply these changes. Because if you're a manager of a company, you're not just going to apply these changes without actually calculating, forecasting what you think the end result is going to be. So let's look first at our current situation. In our current situation, we're selling 4,000 units. And we have, to get to the NOI, we have to look at our sales minus our variable costs, which gives us our contribution margin, minus our fixed costs, which equals the net operating income. This is always going to be the same. So this we need to know like the back of our hand. So in our current situation, we have sales of $200,000. How did I get this? Because we're given the number of units and the per unit selling price, I just multiplied the two. Then we have our variable costs. So again, we're given the per unit costs, which is $10, and we're giving the number of units. It's always going to be the same as in the sales scenario. So we're going to get 40,000, and I'll just explicitly write it out. Okay, so the difference between these two is going to be 160,000. And we can calculate that on a per unit basis if we want to. It ends up being $40 per unit. Okay, so now We can subtract out our fixed costs that are given of $15,000. And we arrive at $145,000 for our current net operating income. That's the situation that we have now. Now we're going to look at a scenario where we make these changes. So before we had 4,000 units, we're not going to have 4,000 units anymore because, as mentioned in the question, we expect that annual unit sales will increase by 50%. So what I've done is I've just multiplied by 1.5 because then the result I get represents an increase of 50%. You can also just multiply 4,000 times 50% to get 2,000 and add that to the original 4,000 to get the 6,000, the new number of units. Okay, so we have these 6,000 units now. So we're going to have to take into account the 6,000 units when we calculate everything else here. So for sales, previously we had a $50 per unit selling price. But what happened here? The sales manager thinks that we should reduce this selling price by 10%. So a 10% reduction for $50, that's going to be a $5 reduction. So our new unit cost is 45. New unit price, I should say, is $45. So let me explicitly write out the units. 50. So this is how I'm getting the new. Before we had 50, now we have 45. So we have to multiply this new unit selling price by our new number of units. So we will get, for sales, 270,000. And the way that we did that is by multiplying the $45 by the 6,000 units. Okay, so that's looking good so far. We have an increase in sales with this new situation. But of course, our NOI, whether it increases or decreases, is also going to depend on our cost. Yes? Yes, so it represents 10%. So the manager thinks that a 10% reduction in the sales price will help them boost NOI. Yeah, so the 1.5 is representing the fact that with this new situation, we expect annual unit sales to increase by 50%. So if you think about it, so the way that you increase a number by 50% is you just can do multiplied by 1.5 to get the new number of units. But another way to look at it, if it's easier, is say, okay, what's 50% of 4,000? 2,000. So add that to the 4,000. 4,000 plus 2,000 is 6,000 in order to get the new number of units. No problem. So if you had 30% increase, you would have a 1.3 here. Okay. Now we have variable costs. Our per unit variable cost hasn't changed. There's nothing about that in the problem. So we're going to keep that at $10. So in order to calculate the total variable cost, then we just have $10, but we have to account for the new number of units of 6,000. So we get here $60,000. Okay, so we know that the contribution margin is just the difference between these two. So we'll get 210,000. Now for the fixed costs, so for each of these items, what I think is a good way to do it is just to evaluate, did this change? Did this change? How did this change? So fixed cost, it's not going to be 15,000 anymore because the problem states that they think that they should spend $30,000 more on advertising in order to achieve this. So rather than just have 15,000, we're also going to have an additional 30,000. So the total will be 45,000. So we're accounting for all these variables to basically see if we change each of these items by what we've specified, what happens to our profit.
Can you just explain how you got the 45,000?
Sure. Yeah, so the 15,000 of fixed cost was what we had before. So that doesn't change because if something happened to that, if that were to go away somehow, it would be specified in the problem. Fixed costs are fixed. They should stay the way they are unless otherwise stated. However, there are now these advertising expenditures that we're adding in this new situation. So we have to add 30,000 to the 50,000 in order to get the new fixed cost.
So advertising is always considered a fixed cost.
Yeah, exactly. Yeah, so you pay for a commercial to run in the beginning of the year. It's not going to change based on the number of units that you produce or sell. Okay, so if we subtract the fixed cost from the contribution margin, we get a new net operating income of 165,000. So our net operating income increased. And in order to, the question is asking for how much did our net operating increase or decrease. So we know right away it's not going to be any of these decreases, right? We can see clearly it increased. And of course, to get the actual amount, you just subtract the two. So we have 165,000 with the new scenario, 145,000 before, and that gives us 20,000. Make sure not to mix up the order. So this is what we're changing to, so that's going to be, we want to see what happened when we changed to this situation, so that's going to be on this side of the equation. Otherwise, you would have, let's say, by mistake, you would have a $20,000 decrease. So just step back and see, did it increase or decrease, and that'll avoid the mistake. So $20,000 increase, choice A. Okay, so what's next? We are going to skip question 20 for now because it's pretty much the same kind of thing as the question we just went over, question 19. It's just more practice, and go right to question 21. So this is another question that's asking for under or over applied overhead. Okay, so a company uses direct labor hours as the allocation base in its predetermined overhead rate. At the beginning of the year, the estimated direct labor hours were 1,500 hours. The total estimated manufacturing overhead was 30,000. At the end of the year, actual direct labor hours were 1,300 hours, and the actual manufacturing overhead for the year was 29,000. Okay, so with that information, we're able to calculate the over or under applied manufacturing overhead. So when I look at this question, I see a few things. So I know when I'm calculating when I'm calculating under or over applied overhead, I'm always going to be looking at two things: my actual overhead and my applied overhead. So it helps to just lay this out in the beginning because that's ultimately what we're trying to find. So then we can focus on trying to figure out each of these components. So lucky for us, the actual overhead is pretty easy because it's given very explicitly, $29,000. Seeing this allows us to just focus our attention on the applied overhead, and then we're less likely to get confused about what we're doing. So, okay, applied overhead. How do we always find applied overhead? You're always going to be looking at your predetermined overhead rate, which is calculated at the beginning of the year, and multiplying that by your actual direct labor hours. Okay, so we know this. It's given. 1,300 hours. We don't know our predetermined overhead rate, but that's easy to calculate. So predetermined overhead rate is always our estimated manufacturing overhead over our estimated allocation base. In this case, it's direct labor hours. So that information is given as $30,000 for estimated overhead. And estimated direct labor hours is 1,500. So remember, predetermined overhead rate, it's always estimated over estimated. Actual never comes into the picture until we get to where we're actually applying. Okay, so then this gives us $20 per direct labor hour. Now we can bring this here. And we will get $26,000 of applied overhead. Then we bring this to our main equation, which is what we're trying to figure out the whole time. Now we know what it is. It's 26,000. Okay, so just we take this difference. We get a $3,000 difference. How do we know if it's under or over applied? So we can just see, right? We applied 26,000, but the actual was 29,000, so we applied less than what we should have. So we're going to have an under-applied overhead. And we calculated the difference already as 3,000, so the choice is A. Okay. Okay. Now we'll move to question 22, which is a margin of safety question. So we're given the following information. A company revealed that they have sales revenue of $840,000, contribution margin of $504,000, and NOI of $54,000. So we're trying to figure out what the company's margin of safety is in dollars. So the first thing is to remind yourself what is the margin of safety. And we know that I'm abbreviating margin of safety as MS. It's going to be our actual sales minus our break-even sales, which I'm abbreviating as BE. So basically, how at the current point, how many sales, what's the amount of sales that we have to cover a situation where we're going to have zero profit? So the name margin of safety is pretty intuitive, actually. Okay, so again, I like to approach this by saying, well, which of these components do I have already? We're given the actual sales straight out in the question. So now all we have to do is focus on the break-even sales. And how do we find those? Okay, so similar to a few of the other questions that we looked at, we're going to use this information that's given to gather other information that helps us get the break-even point. So we know that the contribution margin is $504,000. We don't know what our fixed costs are. We always need to know what our fixed costs are, as you'll see in a moment, because we're going to work through that same equation, profit equals sales minus variable minus fixed costs. So we need to find this. We don't have it, but we're given the net operating income of $54,000. So understanding that the contribution margin minus the fixed cost always equals the net operating income, we can arrive at this number, which is going to be $450,000. Okay, so we have our fixed costs. The other thing that we're going to need is, and this specifically is important for when we're looking at the dollar break-even point, the dollar margin of safety, is again the contribution margin ratio. Okay, so the contribution margin ratio is always going to just be the contribution margin over the sales. So we have both of those pieces. 504, 840. Okay, so we get a ratio of 0.6 or 60%. Now we can look at our basic equation that we looked at before. So profit equals sales minus variable costs minus fixed costs. So again, this is the tricky part. Fixed cost is always pretty easy once we actually get it. It's just one number. So we have 450,000 there. And we know that that's not going to change. Sales and variable costs change based on the number of units, which is why we can't just subtract out a number that we're given in the problem. So we express this, in this case, as a contribution margin. And of course, we know that the break-even, so let's not lose sight, we're trying to find the break-even sales, which means that the profit is going to be 0. So we replace profit here with 0, and then we want to use the information we have to manipulate this in a way that will give us what we want. So the contribution margin I'm expressing as the contribution margin ratio times sales because we have that ratio. It's not going to change. So just a reminder, that's the contribution margin. Okay, so now we can figure this out. Because we found out the contribution margin ratio. We're trying to figure out our break-even sales. Okay, now we solve for the break-even sales, so we isolate break-even sales to the left side of the equation. So again, so this is the fixed costs over the contribution margin ratio, which you'll see as one of the formulas you can use in your textbook. I think it's better to go through the whole process because then in a case where you don't have the contribution margin ratio and that's the only formula you know, you'll be stuck. So we get the break-even sales of $750,000. And now we have both components that we needed to calculate the margin of safety. So if we subtract the break-even sales from our actual sales, then we'll get a margin of safety of $90,000. And that's choice B. Yes.
Can you explain the break-even sales happened to the variable cost of sales?
I'm sorry, so this part? So basically what I'm doing is just starting with the calculation of just knowing that profit equals sales minus the total cost, which is comprised of variable and fixed costs. I want to get this sales minus variable cost in a form that allows me to derive the break-even sales. I know that the contribution ratio, even in my case of break-even sales, in any case, is going to be the same. Because if the units change for variable costs, they also change for the selling price. So that ratio is going to stay the same. So then I can just, because of the given information that I have in this problem, I'm going to just use the fact that I know that I have fixed costs, which I always need. I'm going to use this 0.6 basically as a way to get to the break-even sales. So I think with these, it's really important to just, as the professor mentioned, to just practice over and over because they're always giving you different information. So that's why I'm emphasizing, and Ryan did the same thing, this main equation of profit equals sales minus variable cost minus fixed cost, because then you can go down the line and see what you have and manipulate the equation in any way that suits you for the problem. Yes.
If we have time, is there a chance you can give us basically generally what equation are the most important for this specific exam that you need to memorize and not like this one of them? Is there a few?
If there's time, yeah. But what I want to say for sure is that all of the review problems, if you go through all of them, then you'll know all of the equations that you need to cover, and they're all important. So it's not so much about, so to go back to your question, so you can memorize, let's say, break-even sales equals fixed cost over contribution margin ratio. You can do that, and in this case, you would have arrived at the right answer. But then say in the problem, you don't actually have the information that's going to allow you to get that, or maybe you have it, but you're not really sure how to get there. It's not as easy as it was in this problem. Right. I think it'll trip you up. But if that's, some people work better in just knowing these are the specific formulas, and that's totally fine.
But here is the thing.
you know not just that, but the multiple formulas, say this plus 3 or 4 more, then you can.
Then
get
you're
the
good.
answer anyway. And
Exactly.
that's my question. Which formulas are there? You just name like 3 or 4 or whatever.
We'll see if we have time at the end. But I would just recommend going through all these, and it'll cover, when you're working through them, you're going to cover the ones that, you're going to need to know everything that's covered in these problems, and you'll see the ones that you need to know. Yeah.
I'm very confused about the 2 lines over where you have the CM ratio times the sales. Isn't that supposed to be the break-even sales?
No. So the CM ratio times the sales is the contribution margin.
Yeah, but sale over there is supposed to be 840,000, 840,000.
Yeah, so we're given some information in the problem about what we currently have for the company. So we currently have 840,000. Now, using the information that we currently have, we can, for instance, in this case, find the contribution margin ratio for the information that we have already in order to find the break-even sales, because the break-even sales are going to be a different number than the 840,000. It's basically working backwards. You're trying to see, okay, this is the information I know. These are pretty much how all of these problems are. They give you some information, and then you have to figure out a way to get to the information that you actually need, that you actually want. So we're using that information to get to, in this case, the CM ratio, and also to find out the fixed cost. Then we could plug it into our break-even formula. So that's why it's good to just keep in mind like what we're trying to look for. Like, okay, I know what the break-even formula is, so what do I need to find that? Oh, I can use this information to figure that out. That's basically how it works. These just require a ton of practice, these Chapter 6 ones. And then you'll start to get the hang of it, and you won't even have to really think about it too much if you practice enough. Okay, so next we're going to look at question 23. And I am seeing that I only have 3 minutes. But again, you're going to get all of the solutions. If there's the ones that I skipped over, if you have questions, post to the discussion board, and we'll make sure to answer it. You'll have the solutions, but maybe you have a question on the solution still. Then you can post to the discussion board, and we'll make sure to answer them. But is it okay if we go through this whole problem, Ryan, or no?
That's how long you want to take for it, or
Okay. Okay, so in this case, we're again using the high-low method. I'm just going to go through it very quickly because we don't have much time. So we have the high-low method, and what we want to do again is locate our high activity and our low activity. So we know for June, that's our high activity, 7,000 machine hours, and in April, it's our low. Okay, so we're specifically looking here for a cost formula for maintenance. It's not the total cost as it was in the previous problems, it's just for maintenance. Our given information here is that maintenance is $7,000. That's for a specific level of activity, 4,000 machine hours. And that, in this case, is the low level of activity, right? We have 4,000 machine hours as a low level activity. Okay, so we have that. We want to figure out, for the maintenance cost, what's the variable portion and what's the fixed portion, because then that allows us to estimate what we're going to have for a case of 7,600 machine hours, which we haven't had in the past, but we think we might in the future, so we want to see what it's going to be, and we're using this past information to do that. So overall, we're going to try to find we're going to use the high-low formula, but it's not going to be for the total cost. It's going to be for this maintenance mix cost. We have it for the 4,000 machine hours, which is the low level. So we want to find it for the high case, because then this allows us to use the high-low method. Okay, so in order to find the variable cost per unit for utilities, these are the components of overhead. We can simply use this given information for the 4,000 machine hours. We have a total cost of 8,000. We have 4,000 machine hours, so that's $2 per machine hour for utilities. Okay, we have supervisory salaries. That's fixed. It's not going to change for any level of activity. It's going to be 4,000. We don't need to do anything there. Okay, so because we know those two components of information, we can now get, and we know the total overhead cost, we can now get the maintenance mix costs. I know I'm rushing through this, but when you go through the problem, it'll make even more sense if it doesn't now. Okay, so for 7,000 machine hours, I'm focusing on 7,000 because that's the high activity here. We're going to have overhead of what? So we're going to have utilities. There's different components of overhead. Now that we calculated this per unit cost based on the 4,000, we can use this to get to the utility cost for the 7,000 machine hours. We have 14,000. These supervisory salaries.
You mean at 4,000 machine hours?
We're calculating now for the high level of activity. Yeah.
Utility what? Utility
Equals.
It's
a little sloppy handwriting, yeah. All right, so supervisory salaries equals 4,000. We know that it's the same for the 7,000 as it was for the 4,000 because it's fixed. It's not going to change. We have this missing piece, which is really what we're interested in. Maintenance. This is the mixed one that we're interested in. We don't know this. However, we do know the total overhead costs at this $7,000 machine hour level. It's $28,750.
Why are you doing 7,000?
The reason why we're doing 7,000 is because ultimately we're going to use the high-low method. So 7,000 is the high level of.
Total overhead for 7,600 and just subtract utilities and fixed salary.
So there is another way to do this. I think that this is the most straightforward way. Yeah.
Why did you divide it by 1,000? Like, why did you use the utilities?
So the reason why is because I wanted to get this per unit, this per machine hour cost, because ultimately I'm trying to find, in the end, right, I'm trying to look at the high maintenance mixed cost at the high case, and that is going to be, I'm not sure. But I have the low, and that is $7,000 in this case. So I'm trying to get here by using the information that I'm given for the 4,000 to arrive at basically what the maintenance cost for this high case is. Then I can continue on and do the high-low method. This is going to take time with this problem. If you haven't looked at it yet, if you haven't looked at it before this class, before this review, it's not going to sink in until you work through it yourself, but this, you'll be able to refer back to this tape and it'll make more sense. Okay? So, we're able to get the maintenance cost now for 7,000. Again, let's put high. We're not focused on low because we have it already. The question is asking for the total maintenance cost. That's why we care about the maintenance costs, right? Okay, so of course we can get to this. We have 3 of the components out of 4. So if we subtract these 2 factors, these 2 components of overhead from the total overhead, which is given, we get $10,750. Now we have the maintenance cost for the high level of activity. Now here is where we actually do our work. We had this information before. That was fine. Now we're going to, we also had the $7,000 of maintenance costs. What we were missing was this. This problem is different from the other problems because it's not, from the other high-low problems, because it's not asking for the total overhead cost. It's asking for this specific component of overhead, which is a mixed cost. So this is why we're doing this extra work. And it's very important that you know how to do this. So take some time with this. This is one of the more complicated questions on the review. But this, if you understand this, then you understand everything about the high-low method and mixed cost for the most part, and you'll do well if that question's presented on the exam. So we didn't know this, but now we do because we did this work. Now we have the easy case that we did last time, where we just have the high, low, we need to calculate the difference, get the variable costs, use that, find the fixed costs. So let's take this difference. So there we go. So what did we do before? We wanted to estimate the variable cost per unit. If you know the variable cost per unit is 1.25 per machine hour, then you could find the fixed cost just by plugging in either for the high or low case. And then once we have the fixed cost, then we could figure out our estimated maintenance cost for the 7,600 machine hours, which is what we're trying to find. Okay, so now I'm going to just erase this. Now, let's use the data from the 4,000, from the low level. Again, you can use high or low, it doesn't matter. To get the fixed costs. So again, we're going to have $7,000, the same, this is y equals ax plus b, a plus bx. Okay, so we're going to have 7,000. Where does that come from? It's the total. Now we want to see the mix. What's the mix between variable and fixed? This fixed, we don't know. A is fixed cost. We know the variable cost per unit now, though, and we know the number of units of 4,000. So we can just do this. And then we solve for fixed costs for A. And we get 2,000. Now, because we have this fixed cost of 2,000, and because we have this, we can estimate the cost for an activity level of 7,600 machine hours. Because maintenance is a mixed cost, we need both. We need to know the variable cost per unit and the fixed cost.
What equation will you use then for that now?
I'm going to go over it now, yeah.
If you calculate fixed cost based on the total for the high-low, you get 6,000, not 2,000.
Right, that's why we went through all of this, because we're concerned about only this
Wouldn't the fixed
maintenance
cost be
portion.
the same regardless? Shouldn't it be the same for total production versus
So the
maintenance?
total mixed cost is of 6,000, what that really is this 4,000 fixed salaries plus the 2,000 that we get. The 2,000 is the fixed portion of this. That's why you get 6,000. You don't need to know that to get this answer, but it works out. Okay, so now going back to what we do once we have this information, the whole point here was to figure out this maintenance costs for the 7,600 machine hour case. So I don't really have room here. I'm going to get rid of some of this. We're going to use this same y equals a plus bx formula. Whenever we're dealing with the mixed costs, we're going to use that. So now we have the fixed portion. Fixed. We know that. It's 2,000. We also have the variable cost per unit, 1.25. Now all we have to do is plug in what we care about. We care about 7,600 here. If it said 8,000, we would plug that in. If it said 9,000, we would plug that in. We care about the 7,600. So Exactly. So this will equal 11,500. There are different, if you feel comfortable doing this another way, fine. This is the way that the solution is going to be presented on your, So this is like the easiest way to grasp for a lot of students, but if you're good with math and seeing the links, you might want to do it a different way. So the solutions are going to be posted soon, but I can give it to you. Yeah. 14 first, E. 17A, 20E.